Welcome back. Today we're diving into an analysis report on Beyond Meat, which makes a pretty bold case for it being the best penny stock for 2026.
A very bold case. It's built around its recent debt restructuring and what it calls massive short squeeze potential.
The structure is definitely clear, and the narrative, this whole moonshot thesis, is, it grabs you right away. So let's jump in and see how we can make that conviction even sharper.
Sounds good.
So a key theme running through this material seems to be establishing this explosive moonshot narrative. The title itself sets up a huge promise, asking, is Beyond Meat the best penny stock for 2026?
Yeah, and that's really where I think the first big opportunity is. The report needs to resolve the structural dissonance between that aggressive framing of the title and the much more qualified conclusion it reaches.
Ah, okay. So a disconnect. You're saying the title makes a promise that the final verdict doesn't quite deliver on.
Precisely. The weakness here is that you're asking a superlative question, is this the best? But then the conclusion, it sort of backs away. It doesn't say best, it says it has the highest upside potential.
Which is not the same thing.
Not at all. And that qualification, it just weakens the entire impact. It kind of undermines the core argument, especially when you set the bar so high right at the start.
That makes perfect sense. The reader is primed for that huge claim, and then pulling back at the finish line, it almost creates doubt where there shouldn't be any.
Exactly.
So how do they fix that? I mean, how do you justify a claim like best without adding, a whole second report comparing it to dozens of other stocks? That would really slow things down.
Well, the suggestion is actually pretty straightforward. To justify that best claim and strengthen the whole argument, the analysis just needs to introduce its own criteria for selection.
Ah.
And then briefly benchmark BYND against the field using those criteria. Show why its unique factors, the brand recognition, the squeeze dynamics, the survival runway, make it superior.
I like that. So they're not comparing everything, they're just defining their terms. They already have the data points, they just need to frame them as the reason it's the best.
Precisely. They can add a small, really efficient section that just details the criteria for best. Things like liquidity runway, which the debt deal solves, or consumer visibility, which is what separates Beyond from, some unknown microcap stock.
Right, and then use that to draw a contrast.
Yes, exactly. Explicitly contrast BYND's massive brand recognition with, say, a hypothetical competitor. It could just be half a paragraph, but it shows why this isn't just another generic deep value play.
That's super actionable. It really grounds the superlative claim. And then I assume they have to carry that confidence all the way to the end.
They have to. The conclusion needs to reflect the confidence of the opening. No more hedged language. They need to close with the conviction they started with.
And that 2030 runway from the debt deal, that's really the core of it, isn't it?
It's the biggest advantage. So many penny stocks just die because of a liquidity crisis. Beyond Meat solved that. Yes, it came at a huge cost, but that cost bought them time. And highlighting that as the primary reason it's the best option, that reinforces everything.
That framing turns the debt deal from just a stability point into a real competitive advantage in this speculative space. Okay, let's turn to the rocket fuel section. The material makes a really strong case for a rally by pointing out that incredibly crowded short trade. What is it, something like 37% of the float is sold short?
It's a huge number. Over $400 million betting against it. And while identifying that is crucial, the analysis really needs to dedicate some space to defining the specific operational threshold required to actually initiate the squeeze.
Okay, so they've identified the fuel, but what's the weakness in how they talk about the spark?
The weakness is that the report almost treats the short squeeze as an automatic outcome of just any positive news. And for volatility play this critical, you can't do that. The analysis relies way too heavily on the mechanism without stress testing the catalyst.
Right. The people shorting this stock, the ones betting hundreds of millions, they aren't amateurs. They're not going to be scared off by a simple press release.
No, they're betting on terminal decline or sustained massive cash burn. General positive news is not going to be enough to force them to cover their positions en masse.
So it's a key distinction. They don't just need a reason to stop shorting, they need a reason to panic and buy back their shares. And that requires a real shock to their thesis.
Exactly. If the core short thesis is, this company runs out of cash, then the only thing that breaks that position is proof that the cash burn has fundamentally changed.
So the suggestion here would be to, create a whole dedicated discussion around this trigger threshold?
That's the idea. Analyze what specific, measurable, event-tied directly to those turnaround catalysts they mention would actually force a mass covering event.
That would definitely strengthen the argument. It connects the speculative part directly back to the fundamentals.
It grounds the rocket fuel, and they can do it by modeling a specific financial target. For instance, the analysis could argue that shorts will only really start to cover if the gross margin stabilizes above, say, 15% for 2 straight quarters.
Oh, that's interesting. Because hitting a 15% margin would be a huge signal that Product 4.0 has maybe solved their structural cost problems.
Right. It makes the path to profitability look much clearer, and defining that specific inflection point, that gross margin number, makes the whole volatility thesis so much more robust than just hoping for good news.
And this connects to the Walmart deal, I assume.
It has to. They should explore how that increased volume from Walmart specifically translates into reduced cash burn, maybe in Q1 2026. Because that's the moment the 2030 debt extension becomes truly valuable.
Got it. So you define that financial inflection point, the moment cash burn drops below a certain level, and that becomes the likely trigger for the squeeze.
Yes, it establishes a clear cause and effect. The operational news has to directly threaten the short sellers model to create the volatility they're looking for. It just feels much more rigorous.
Okay, let's switch gears a bit and transition to the fundamentals, specifically that deep value snapshot. The report talks about the incredibly low price-to-sales ratio, 0.25x.
Right, and it interprets that as distressed pricing with huge potential for expansion. And I agree, but the connection between the operational catalysts, Product 4.0, the Walmart deal, and that projected 3 to 4x multiple expansion, it needs more granular quantification.
Okay, let's pause on that PS ratio for a second. 0.25x. For anyone less familiar, what is the market actually saying with a number that low?
A ratio like that implies one thing, really. The market is betting on terminal decline. It's signaling that revenues are expected to fall off a cliff, or that insolvency is basically a given.
So a PS of 1.0 is sort of a baseline for a struggling company.
You could say that. So 0.25x is essentially pricing in that 75% of future revenue is just going to vanish, or that the current revenue is totally unsustainable because of the losses.
So the weakness is that the analysis identifies this deep value, and it lists all the right turnaround factors, the new product, the Walmart deal, but it doesn't actually connect the dots. It doesn't link those operational wins to the financial re-rating.
Correct. The leap from a PS of 0.25x to, say, 0.75x or 1.0x, it feels speculative. It feels like a guess rather than something that's data-driven. They list all these great turnaround catalysts, but the valuation part feels disconnected. They need a bridge.
Okay, so what's the suggestion? How do we build that bridge and make the deep value argument more credible?
Introduce a high-level, scenario-based approach, one that actually illustrates how an improvement in a specific operational metric mathematically supports the multiple expansion they're projecting.
And gross margin seems like the perfect lever to pull for that since it's the most critical factor, and they have the current number.
Absolutely. They should model what the PS ratio might look like if the Product 4.0 pivot successfully pushes that margin up to, say, 15% or even 20%.
That gives you a clear quantitative link.
It does. For example, if they could clearly state, achieving a sustained 20% gross margin justifies a PS multiple of 0.75x based on comparable companies, then suddenly the argument becomes rock solid.
Because that directly links the operational execution with the speculative valuation expansion.
And it all connects back. It shows how the Walmart volume provides cash flow stability, which in turn justifies that higher multiple, which then supports the survival runway from the debt deal. You use the risks they mention, like the negative operating margin, to frame the opportunity. If cost cuts in volume fix that margin, the PS expansion is justified. And critically, it's quantified.
It's really about building a logical sequence of events then. Survival is guaranteed by the debt. Operations improve the margin. The better margin justifies a higher multiple. And hitting that specific margin threshold is what triggers the squeeze. That's a much more sophisticated thesis.
It is. The components are all there in the report. They just need to be interconnected with mathematical clarity, not just narrative enthusiasm.
This is a really powerful analysis report. It has a compelling narrative, and it correctly identifies this, unique combination of brand recognition, squeeze potential, and that survival runway.
Absolutely. The framework is strong. The follow-through just needs that quantification and a bit more structural alignment.
So the primary focus for strengthening it should really be threefold. First, align the title's aggressive best claim by briefly benchmarking against competitors using their own criteria. Brand visibility and runway. Second, define that specific operational threshold trigger, probably centered on gross margin. that's needed to ignite that massive short position.
And finally, quantify how those operational wins, like the product 4.0 improvements, actually lead mathematically to that projected 3 to 4 XPS expansion. Build that data-driven bridge. Right, that would really solidify the deep value argument.
All highly actionable suggestions. I think they're really designed to maximize the conviction of what is, a very high-stakes moonshot thesis.